Greetings to all the students of Khan Noor University. This is technically your fourth week but fifth lecture of international business regarding BBA students for 7th semester. My name is Imtiaz Sharifi and my contact details are as usual here. Today we'll be studying about international politics and economics integration. Political ideologies and economics, political and economical systems, and lastly how government control assets. Let's just start quickly with what is the meaning of economic integration. Basically, it's an arrangement among nations that typically includes the reduction and elimination of trade barriers and the coordination of monetary/policies. If I explain this more, basically there are certain trade barriers in every country. They include tariff, they include price valuation, they include what goods not to come to another country. When you have an economic integrity with another country, you tend to have the flexibility and the choice of making an economic integration with another country. It aims to reduce cost for both consumers and producer and to increase trade between the countries involved agreement. So it's economic integration agreements also. You have to sign agreements with WTO, with WCO. I'll give you more examples later. It's sometimes referred to as regional integration, as it's often among neighboring countries and nations. Why it's regional? Because we have got neighbor countries like whichever countries are closely bordered with, they tend to have a flexibility or economic integration because they are neighbors and partners in economic reforms and stability. It's a process whereby countries cooperate with one another to eliminate barriers of international flow of product, people or capital. It takes place either on region or commodity. I mean, that's in simple words the meaning of economic integration. What are the advantages of economic integration? First and foremost, it's trade facilitation. I'm sure once you reach into the business community, business world, customs all have got number one purpose of facilitating trade. A wider selection of goods and services are available at a lower tariff and cost. Due to lower tariff and removal of tariffs in some cases also, hence we get cheaper and lower prices. It encourages a trade between member countries. The balance of money spent from cheaper goods and services can be used to buy more products and services. I mean, that's how one country makes advantages. When there's money is stored from the savings that they have done by procuring cheaper items, they can procure other enhanced services and products. Another fine example of economic integration, I will not go in much more detail into this area, it's the employment opportunities. Basically, it somehow more employment and jobs are created with economic integration. What are disadvantages, to be honest? Sometimes it's the creation of trading blocks. Blocks, it means it increases trade barriers against non-member countries. If you have a trade economic agreement with a neighbor country, other countries cannot take advantage of the same tariff and the same valuation and the same incentive packages that you have given to another country. It also creates trade diversion. Because of trade barriers, trade is diverted from one non-member country to a member country despite the inefficiency in cost. For example, a country has to stop trading with a low-cost manufacturing in a non-member country and trade with a manufacturer country which has higher cost. Again, what I mentioned, the trade diversion has been replicated. A country has got to be forced to do business in a country where there's higher cost of labor, higher cost labor of goods, because he does not have that economic integration with that country. Mostly it's national sovereignty. Sometimes some key countries do give up degrees of their control over key policies like trade, monetary, fiscal policy. The higher level of integration, the greater the degree of controls that need to be given up, particularly in case of a political union. Economic integration requires nation to give up a high degree of sovereignty. Sometimes you have got a pride in a key product. Sometimes that's your key selling point. Sometimes you have a proud nation part. But when you tend to go for an economic integration, other countries can also benefit from that product, and hence you lose your national sovereignty. Let's come back to what are the different levels of economic integration. Number 1 is preferential, 2 is free trade, 3 is customs, 4 is commons market, 5 is economic union, 6 is political union. I'll go briefly into all these elements, what it means. PTA, also known as preferential trade agreement, is the simplest and loosest form of economic integration. It offers members country a tariff reduction in certain product categories. Let's not forget, it's not all, but only certain products. Discrimination of or preferential treatment for some countries is not allowed, as it's against the principle of most favored nations under WTO. WTO is the Organization of World Trade Organization. They control the trade of all the countries, and they can somehow stipulate to which countries are most favored. Hence, discrimination is not allowed, because you cannot do business with one country and rest countries cannot do that kind of business. But you do have an option of doing a prefer. There are two countries, they offer the same prices and good, but you prefer to do business with that country. It's a unilateral relationship, as tariff would be reduced only in one direction. I mean, here, whatever tariff you have got going and country, that whatever you import and you export to that country, it's being considered as a PTA. A fine example is India and Pakistan. They gave us medicine, we produce pomegranates, we give them all the things that we have, our dried foods, our jalgozas. First we send it to India, and vice versa. In this tough crisis, India has been kind enough to give us so much tons of hydrochloroquine, the drug that is fighting corona. But that's something of a goodwill gesture. Let's not forget that. They're also doing business with us in terms of so many other products. Could be medicine, could be textiles, could be clothes. India is a good economic partner with Afghanistan. WTO has registered 200 countries which do PTA between themselves. So you have got to register yourself in World Trade Organization in order to be able to take advantage of preferential trade agreement. The Commonwealth countries, to be honest, the UK Empire, they are not the UK, but UK is part of the Commonwealth preference system. It was established in 1932, and it has got 48 Commonwealth countries of the British Empire. They do business of PTA very openly, very closely, and they have got many agreements to which these countries fall into. Let's go to another one. This is 2. It's a free trade agreement. Let's just assume it's an agreement between 2 or more countries to remove all trade barriers between themselves. Free trade occurs when a group of countries agree to eliminate tariffs between themselves but maintain their own external tariffs on import from the rest of the world. Example is the Asian Free Trade Agreements, the North American Free Trade Agreement. If you look at the graph, you have got country A, you have got country B, and you have got country C. What they have done is you can do a free trade in all these 3 countries. You can bring in goods at the same price or free, or whatever rate you have established yourself to be. But if a 4th country is coming into, that have got to pay the trades, the tariff. Even in some case like country C can do free trade, but they impose their own tariffs. Tariff is the amount of percentage that they charge which each goods are imported into a country. That's free trade for you. Number third is the customs union. Customs, as you know, all goods and services come through customs union. An agreement between two or more countries are set up to remove tariff between themselves and set up a common external tariff on imports from non-member countries. Each country determines its own barriers and maintains its own external tariff on import against non-members. A custom union has common policies on product, regulation, movement factors, goods, services, capital and labor. Fine example of this is the European Union. European Union can import things from country in China, and China can assemble parts and sell it all to other countries. I mean, if you look at the diagram, imported components to Norway from China duty free. I mean, Norway is a European country. It imports goods from China. I mean, if you look at exported finished products from Norway to EU, they all have got their own country in terms of customs tariff. And if you look at the third way, is EU tariff is payable on non-EU countries under the rules of origin. So they look at a product where it came from. If they haven't came from European Union, then they have to pay a tariff. If it has came from European Union, they don't have to pay any duty free or any customs. That's called custom union. It's a simple, straightforward. Is most countries, they hold an agreement of how to control custom unions tariff. Fourth one is common market. To be honest, common market is an agreement between two or more countries which removes all the barriers to trade and allow free mobility of capital, labor across member countries. They harmonize trade policies by having external tariff against non-members. Example is the European Union, as I mentioned earlier, but fine example is the Africa Union. If you look at Latin Africa, developing countries, Europe, all these countries, for example, they export coffee between common Africa, East Africa and the South African developing. They have got no tariff between these countries. They can take coffee from Angola to Libya or from Egypt to Botswana. There's no charges for that. But if they are going from here to Europe, then the charges will apply on both countries, on the tariffs, on the import, on the export. So you can imagine there's 26 countries in Africa. That's how much population they have, 625 million. They all have got a common market. Free trade is allowed in Africa. But if you're going outside Africa, then they have got to pay charges. Economic union, this is an important one. I mean, an agreement between two or more countries to remove trade, to allow free labor, as mentioned earlier, and capital to coordinate economic policies. They set up trade policies through common external tariff on non-members, to be honest. Integration is more intense in an economic union compared to a common market. They are required to harmonize their tax, monetary, fiscal policies. They even create a common currency. A fine example is European Union, where they have a joint current currency. They have got economic and monetary integration, and they have got a single market. If you look at 1952, they only had 5 to 6 countries. 1973, more countries went into it. 95, 98. Currently, they have got more than 25 countries as a European Union, and they all have got an economic union. You can do same thing what Africa have done. They have done it in here in the terms of economic union, mostly in Europe. Political union. Now this is the hardest one. It's an agreement between two or more countries to coordinate their economic, monetary and fiscal policies. It's a bit difficult. This is policy level we're talking about, political level we're talking about. They are required to accept a common stance on economical and political policies against non-members. Here's an example. In US state, it has its own government. Then they set the policies and law for each state. Each state's grant control to the federal government over policies, agriculture policies, welfare policies, and monetary policies. Goods, services, capital can move freely without any restriction within the US states, and the government sets a common external trade policy. Let me give you a fine example. Trump wants to open up America due to coronavirus. Washington Mayor Mr. Cuomo, his name is, he's saying no. My policy is that I do not want to open Washington. America can open, like the power of US, the president does not have power over its states. So to create a political union, I mean, each state they can do free trade between them countries, but they have to follow one political union. This is the hardest level to reach because not all countries reach the political level. Let me give you a complexity of how easy things are. I mean, the first one is a free trade, the customs, the common market, the economic, the political union. It's the complex level that it's very difficult to achieve. The left hand side, the graph which goes up, it shows to you like you can get the free trade between members agreement, the partial of the Asian countries. You can get the custom ones, you just have to impose the external tariff on it. On the common market, you just have to look at the production that moves freely between two members. In the economic union, you have to accept on a harmonized currency, harmonized tax rate, monetary and fiscal policy. You also look at the political union. That's a big difficult, that you have to make sure that two governments agree on the same policy levels and fiscal monetary values. This is another graph to show you guys the level of how easy it is to accept from PTA, free trade, common market. The highest one is the political union. We are also going to go into a new chapter, to be honest, of the impacts of how countries make up grants. If you look at America, for example, they have got assets, for example, of 3.45 trillion, but they have got liabilities of $22.76 trillion. How and which areas that they spend it, I'll be going into my next slides. The government funding as assets is linked to my previous slide also. Look at this map. It's just the percentage of world debt. If you look closely here, China has got 9.8% debt. If you look at America, they have got $21 trillion debt. I would just like to ask, where do these countries get their loans from? If you look at all these countries, they have got $69 trillion worth of debt. I would like to ask the questions to the students of Hayanur. To where do these countries get their money from? Where they get their loan from? How does IMF manage all these currency? If you look at the debt as a percentage to GDP, this is just a question of today's, that if some students can come up with this answer. What is Afghanistan's debt? I mean, if you're looking at country level, and we are studying this is because we have to closely study business against politics. It goes link by link together. I'll also be teaching a new tax, value-added tax, coming next year to Afghanistan. You as business students have to be aware of all those taxations. How do government make money? Versus, I mean, the idea is versus profit entities, government versus businesses. Government they collect resources and make expenditures to fulfill societal needs. Government do not pay a profit do not have a profit motive, and hence they don't pay the business receipt tax. They don't pay any income tax on what they earn because they are government. Government entities usually have a legal authority for their existence, raising revenue, powers through taxation, and mandate expenditures to provide for services. Again, government use comprehensive budget system. They have an accounting, they have a fund accounting system. They primarily emphasize in accounting to measure its report on management stewardship. Government entities typically are required to establish separate funds to carry their own various missions. Money funds entities do not record fixed assets or long-term debt in their funds. Government have financial, to be honest, reporting systems. As you are all aware, they appoint majority of organization is a governing body, its ability to impose on an organization. They possess financial benefit or assume financial burden from organization. These are all government entity definitions. Government have got, just as any other company, they have got net assets, they have got activities, they have got cancellation of schedules, they have got a budgetary role to play, they have got other required supplementary information, which is RSI. Fine example is how do government again generate funds, where do the funds go to, and what amounts comes to. Accounts of government are usually general funds, special revenue funds, capital project funds, debt service funds, permanent funds. They've got proprietary funds. They've got like non-tax revenue, the Hajj, the mining factor. They sell land to the people. That's how they are prepared. They have got internal service. I mean, if whatever they provide, they sometimes charge fees for that. Fiduciary funds is mostly the pension funds that we're looking at. They give to as salaries what they have earned. Investment trust fund, mostly in India and US. An employee would like to buy stocks or shares, and then there's given to them while they retire. They've got a private purpose trust fund, and agency funds is also part. They set up in US and UK. They've got agencies that set up the whole funds for them. Government, mostly revenue comes from routine operation. Let's just assume the Hajj, the passport, the licensing fees, the traffic fees, they all are routine fees. They also have got specially revenue funds. We have got the Qatiya, the budget. These expenditures are strictly restricted to a purpose. So governments sometimes offer goods or services for sale to the public, such as operations are accounted for in enterprise fund. Buses, the minibus that we have, for example, sports arenas, the cricket stadiums, the football stadiums, is all revenue. Utility bills, the Brishna, the DABs, they all generate. Airport, Ariana Afghan Airlines, these are all companies that bring in revenue towards the government. Every government has got balance sheet, the statement of revenue, expenditures, and I'll be teaching you more in the coming weeks what balance sheet are, what annual income tax returns are, what BRTs are, what withholding contracts are, what contracts, how and government charges taxation. This is a fine example of net assets. I mean, I'll be teaching you more in another face-to-face lecture. It's better if I teach you all this in the classroom, how cash are monitored, liabilities, net assets, how government keep a control of government activities, business activities, how do they make profit, how does the public work, safety work, where the bill from water comes in, and where the expenses goes to. I'll be teaching you all this in graph class, I mean in class, so we can debate, we can go step by step on how it's taught. I'll teach you how the expenditure process works, how the encumbrance works, I mean in terms of the outstandings of some companies that they have, what they buy and when they pay them, expenditure records when are kept, when goods are received or sold. A recognition of revenue, one you must know, property taxes, interest, investment, income tax, sales tax, how do you measure the accrual fees, non-tax fees, license fees, the mobile 10% fees, grants, how do they meet when TAPI comes into this Tajikistan, Afghanistan pipeline, Pakistan, India pipeline is coming. These are all revenues that eventually come into, and how we will be spending all that. You must have to know what are these recognition of revenue. There's personal, there you have we'll skip this part because this is good about goods received, cash payment, interest, all these things. My main slide for next week will be value added tax, which I will teach you all how the value added tax has spread. What is value added tax? It is coming to Afghanistan in 2021, so I want all my students of BBA to know what taxes are, because when you have your own business, you will be facing many different kind of taxes in the future, from your own salary tax to withholding tax to sales tax to value tax. I'll be teaching you all that in my next week's slide. Thank you very much. I'll be for today's session, and we will hopefully continue on next week to what is value added tax. Thank you.